Ansel, what is up, my man? We are
Christian,
here for the 73rd episode of Fed Watch and the first one ever being live streamed on Bitcoin Magazine Live. How are you doing?
I'm doing great. Excited to be a part of the new product offerings here at Bitcoin Magazine, and it's a big show today. I've put together an outline that you saw with Fed news talking about Powell's testimony in front of Congress, and then we have a quick read through of an IMF story, an IMF blog post talking about low income countries and the kind of uh, emergency that's emerging there, and then some headlines out of China and the central bank PBoC over there. Big show.
Yeah, no, so a lot happening. And for all the new viewers out there, Fed Watch, this is the ultimate macro and Bitcoin show. We talk to the leading experts in macro. Sometimes they're not quite on the Bitcoin train. And we put everything into the context of Bitcoin and what is happening. So we've been ahead of the curve on a lot of different trends around the world, including the deflation narrative, the inflation narrative, the supply chain breakdowns, amongst many other things. So make sure to stay tuned, follow FedWatch on your podcast feed, follow myself, follow Ansel, and keep on top of everything that's happening in the macroscape, because that's the game that Bitcoin is playing in, right? It's no longer a toy and a plaything to trade, on Mount Gox. Bitcoin is a macro asset.
Yeah, we have to know where we're going. I think we all know that Bitcoin is going to be the next financial system. It's going to be a huge disruptor, but to know where we're going, we have to know where we are. And I think this show is special because, it's a Bitcoiner perspective, but we, I guess, have respect for the traditional system, and Bitcoin needs to interact with and maybe replace some things in the traditional financial system. And we need to know about that stuff. So that's what we cover.
So Janet Yellen and Jerome Powell had to testify in front of Congress. We got three clips in particular with some senators and congressmen asking Powell some questions, and we want to break them down. Do you want to preface this at all, Ansel, before we jump into the first clip?
No, this hit the headlines, some of the stuff he said about transitory and retiring that term. So we're going to go over that. That's why I wanted to take a look at these three clips. I didn't include any of Janet Yellen because honestly, I have a hard time watching her, even though did you know that she is the only person to be chief financial advisor to a president, chairman of the Fed, and secretary of the Treasury? She's the only person in history to do that, but I still can't stand watching her. So Powell's much better.
Well, I know that you secretly have a hard on for Powell, so that came out on the last episode. So
What?
I don't blame you. Maybe we can get some Janet in there next time. But
Oh
regardless, these
boy.
are really important clips. This was huge news last week, and again, it goes in complete contrast with what's happening out of Europe and what Lagarde is saying in Europe, which is she's doubling down. This is transitory. There is a hump, and in 2022 we're going to go down the hump. Jerome Powell is completely contradicting her and is saying, "Hey, it's not transitory." But enough from me. Let's just get into the clip, maybe.
New flexible average inflation targeting. The inflation target remains at 2%, but now it's on an average over an unspecified time frame. Core PCE, the Fed's preferred inflation metric, is running about above 2% over the past 5 years, nearly 3% over the past 2 years, and 4.1% over the past year. So it's above target, it has been above target, and it's accelerating. And yet the Fed has maintained an extraordinary emergency monetary policy stance. It looks to me like this framework appears to be a weakening of the Fed's commitment to stable prices. Now, I know you believe this is transitory, but everything's transitory. Life is transitory. How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Well, first of all, the test that we've articulated, I think, clearly has been met now. You're absolutely right. Inflation has run well above 2% for long enough that if you look back a few years, inflation averages 2%. So I think we can say that is taken. It was not the case going into this episode. It had been many years since we had inflation at 2%. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
All right. So I'm glad I watched this clip like 3 times last night. But Ansel, give us the breakdown here. We're a couple minutes late on our view.
Okay, well, yeah, sorry, we're still getting the wrinkles out, and when we have video to watch, it's our first live stream, but we will get it, super streamlined for next time. But yeah, so Powell my takeaway is he said that transitory is just a term, and so he's going to retire that term, not necessarily the prediction or the outlook. So they're going to they still have their same transitory outlook. They're just going to call it something different. And the reason why that is because, everyone has their own definition of inflation. Everybody has their own definition of transitory, and they can't clearly signal. And we've talked about this in the past, right? That the Fed's main job is not QE, and it's not low interest rates. It is narrative management or expectation management. And so they can't very well do that expectation management job when they have a word that people get confused a lot. So that's my take on it. What did you hear from that, Christian?
So yeah, I think I kind of got into the analysis before we played the clip, and I completely agree. Again, we're living in clown world. Like, that's the whole point of why Bitcoin is so important, because like no one knows what's happening in the economy, and it's really just buzzword bingo, right? Even QE to some degree is like buzzword. So obviously buzzwords can be confusing, especially when they whip them up off the cuff. Someone said, hey, there's inflation, like, oh, it's transitory, everyone adopted that. 6 months later, maybe it's not. But then you'd go flip around and you'd say Ansel would argue that there's no inflation at all. So again, like it's hard to figure out what's happening in the economy right now. And I think that is the root of the problem to begin with. And this is why we Bitcoin. Bitcoin is this transparent open source layer where you don't need the high priest of the Fed to kind of like read through the tea leaves and talk to Congress about what's happening and all this kind of stuff.
Yeah, well, Fed speak is a thing, right? Quantitative easing is, well, I would say it's not easing, and it's not quantitative. Like if it were actually quantitative by an equation that this amount of easing is going to bring us back into recovery, we wouldn't need QE1, QE2, QE3, not QE infinity. This is by definition, if it's happening multiple times, it can't be quantitative. So yeah, it's just Fed speak. But remember, that is what the Fed does. The Fed's main job is Fed speak.
So should we jump into the next clip? But I mean, hey, I guess before we do, just it is, again, I can't reiterate how huge it is that Europe, they're saying it's transitory. And then now Jerome, as of last week, his position was kind of unsecure and he wasn't saying much. As soon as it seems as though he has a path to being reinstated, he starts opening up and then maybe speaks his mind a little bit more. And now he's going in complete contrast with all the other central banks, predominantly Europe.
Throwing them under the bus a little bit, right? Yeah.
All right, let's jump into the next clip.
Chairman Powell, I recognize, and you've been very consistent, that you manage based upon your direction, which is full unemployment and a 2% interest rate goal. But does the Fed take into account the impacts on national debt servicing and our creditworthiness when it considers interest rate decisions?
I think certainly the cost of programs, it all goes into our model. We don't really see, you mentioned credit risk. There isn't any credit risk baked into treasuries at this time, and I wouldn't expect that there would be, certainly in the foreseeable future.
When you look at this, do you project that treasuries will rise over the next 18 months?
So generally, that's something that that staff has been forecasting ever since I got to the Fed 10 years ago, and it really hasn't happened. What's happened is that, as the Secretary mentioned, you have a series of long-running global forces that are leading to lower sustained interest rates. How long will they last? It's very hard to say, but for now we have lower inflation trend. Obviously, currently at the moment we have high inflation, but for many years we've had low inflation, and the markets are baking in a return to lower inflation.
Thank you, Mr. Chairman. Thank you for your time. Thank you for your answers.
All right, Ansel. So I guess what's your take on this?
Okay, so this was the rounds clip, and he talked a lot about. I thought I was muted.
He talked about credit risk, and he was asked like, "Hey, do you think that our credit worthiness is at stake?"
Yeah, and well, my takeaway from this was something that I haven't heard anybody else say. He was talking about a global interest rate regime, and that there's no threat of higher interest rates, or at least significantly higher interest rates, because there is this global interest rate regime is low. And since he's been at the Fed for 10 years, the Fed analysts have been predicting higher interest rates. This isn't gold bugs or Bitcoiners or Austrian economists. This is the Fed's own analysts have been predicting higher rates, and they have been wrong since Powell has been at the Fed. So he's like, basically what's implied is they don't know why interest rates are low. That's what I take from it. They don't know why interest rates are low, and there's no need to worry about high interest rates because they don't have anything to do with it. It's outside of their control. It's a global thing outside of their control. So, Christian.
So I mean, that's something we've been talking about a lot here, and the dollar system, although it's like quote unquote an American system, it is actually kind of this like weird market, like free market system that emerged, and all of that stuff is outside of what the Fed can actually control, right? They're trying all these things to manipulate interest rates, and they really can't increase interest rates that much more. They have no choice. And yeah, I mean, again, I was kind of saying before, after the last clip, that they just don't know what's happening. This system is a completely opaque. That's the existing system. It's just this weird like monster that has just been mutating since the 70s, since it was removed from a gold standard. And this is what we're stuck with today. And no one is in control. And it's kind of like this just horribly weird beast.
Absolutely. I mean, the only other thing I would have to add is this gets at the point, what I was trying to say is that this gets to the point of the debate between, does the Fed set interest rates, or are interest rates set outside of the Fed's monetary policy? Because all interest rates are in agreement. They're all low, right? That we have a global low interest rate environment. Eurodollar futures, German bunds, Japanese JGBs, and US treasuries. Like everything is low or negative. So there has to be something outside of the Fed that the Fed can't really control.
So I guess just to tease that out a little bit more before we get into the next clip, like when you say outside of the Fed, like you're saying like a free market system, or is it just a cabal of central banks keeping it low, right? Is this just like a collaborative effort amongst these large players to manipulate these supplies to all of their benefits?
Well, my base case is that inflation it's real, and it did happen up until roughly the global financial crisis. And since then, we've had low growth, low credit expansion. And so that's a low inflation environment. So in a low inflation environment, your interest rates are also going to be low. So it's we have peak credit saturation in the world, and something has to give. You can't get out of a debt crisis by adding more debt. And so that is the problem. That's why we're all stuck at the zero lower bound, because you can't get out of it by adding more debt.
And I mean, in terms of debt, everyone's priced out except for the very rich, right? And now we have this situation where only the very rich get access to capital. Everything is inflated, and everyone else is priced out, which just would explain a lot of the other negative second order effects that we're living with today. All the uncertainty, all the just mistrust and anger with the system, the lack of just everyone kind of reaping from growth, and just the lower middle class kind of getting pushed away while the higher classes continue to improve. So I mean, it's all tied together. It's all about the money, and again, that is why we Bitcoin. So I don't know how many times we have to say that, but this show sees Bitcoin as sound money and a way to kind of cure a lot of this stuff.
Yeah, well, Bitcoin is pristine. It's untouched virgin land. Then that's what I think people are going to start seeing. That you're going to see either the traditional system, debt-ridden, old, dying, decrepit, no growth, or you're going to look at Bitcoin and see, infinite potential. And so that's why I think most people are going to switch over to Bitcoin. At least the high power money is going to switch over to Bitcoin in the next few years.
All right, let's get into this last clip. This one was very funny. Mr. Kennedy is definitely a character, but again, I think the response from Powell shows his ability to wheel and deal in Washington for sure. And he's definitely, like, no matter what you think, like, Jerome Powell is a calculated actor, and that's part of our thesis here on the show.
I think it's fair to say that the experts who have been advising you about the future rate of inflation have pretty much the same credibility as those late night psychic hotlines you see on TV. Is the Fed considering increasing the pace of its tapering? We've got to get control of inflation. It's ravaging our people.
So I think what we missed about inflation was we didn't predict the supply side problems, and those are highly unusual and very difficult, very nonlinear, and it's really hard to predict those things. But that's really what we missed, and that's why all of the professional forecasters had much lower inflation projections. You ask about the taper. And so, yes, as I mentioned earlier, since the last meeting, we've seen basically elevated inflation pressures. We've seen very strong labor market data without any improvement in labor supply. And we've seen strong spending data, too. So, and remembering that every dollar of asset purchases does increase accommodation, we now look at an economy that's very strong and inflationary pressures that are high, and that means it's appropriate, I think, for us to discuss at our next meeting, which is in a couple weeks, whether it will be appropriate to wrap up our purchases a few months earlier, as I mentioned.
All right.
But in those 2 weeks, we're going to get more data, and we're going to learn more about the new variant.
Okay. Thank you, Mr. Chairman.
Man, we got this down to a science now.
Yeah, no, it's at least it's clean, but I would like to watch the videos next time. So we got to figure that part out, but yeah. I'm sure we will figure it out for the next time. But again, like I said, I feel like, one, you got to sit and appreciate Powell's ability to kind of respectfully answer this question despite the jabs from the congressman. And so what's your breakdown? And I think at the end of this clip, that's the hot clip, that's the banger where he puts the hammer down on the terminology.
Yeah, well, this is about the supply side effects, and that the reason why that they're so bad at I guess forecasting is because the supply side effects were so much more dominant than they thought they were going to be. We have 90 some ships packed with containers sitting off of Long Beach right now. We have the oil market, which I follow quite closely, is, the US oil production is 1.5 million barrels per day lower today than it was pre-COVID. And so some of these supply side exogenous shocks are very, very hard to predict. And that's what he was trying to get to. Then he brought in the taper and saying that they could quicken the taper or end the taper a few months early. And to me, that's just building on this narrative. You know, what do they want to come away from this, want us to come away with this thinking is that, okay, it's not transitory. So inflation could be heating up and getting worse, and that they're going to end their taper quicker. Oh my gosh, the economy is overheating, guys. It is doing gangbusters out there. Well, that's really not the case. We're slipping back into recession. If you look at things like industrial output, if you look at the financial problems in the emerging markets, the financial problems in China and Europe, I mean, risks are getting higher and the economy is turning over. But he wants to control the narrative again. He wants to push forward that things are overheating, inflation is coming, you need to act like inflation is coming, and hopefully it's some sort of self-fulfilling prophecy that will blunt a downturn. Does that make sense?
So you think he's playing 4D chess here, that he's setting things up and, you know, this is his move again to set expectations in a way that he can move the economy in the way he wants.
Yeah, he mentioned quickening the taper a few times during this whole testimony. And yeah, I think that's exactly why they would do that. He never committed to anything. He never said, we will definitely speed up the taper by 2 months and end 2 months early. But he said, you know, he left you thinking that that was coming. And so, yeah, I do think that this was a massaging of the narrative to kind of play 4D chess, like you said.
So just for the people who may not be, you know, avid followers of this show, why would Powell want to do that? Like, why would he start push this narrative of inflation and why he needs to tighten and strengthen the dollar?
Well, because the Fed's main monetary policy tool, or only monetary policy tool, is jawboning. So they fix the narrative, they fix the story, and they affect market sentiment by what they see, their forward guidance, right? That is their actual monetary policy. QE really doesn't do anything. QE doesn't affect interest rates. QE isn't money printing. This is, you know, there's a ton of empirical research out there that even if you increase the central bank's balance sheet by 10% of GDP, so for the US, that would be $2 trillion, you would get a minute fraction of a percent effect on interest rates. So that's the empirical finding. And I think that their main tool is jawboning and setting the narrative. And then we all kind of walk in lockstep with what we're supposed to do. Don't fight the Fed, remember. That's the big thing. Do not fight the Fed. Well, they need to put that in your mind so that the Fed's mind tricks can work on you.
But why would they want to go against all other central banks, right? In terms of tightening monetary policy when everyone else is going looser. And if anything, you know, a stronger dollar, that pretty much wrecks the international markets, right? Like that's not good. It's tough to say if that's good for anyone.
Well, what does tightening monetary policy, what does that do?
I'm asking you. I don't know. I mean, well, theoretically, they're raising interest rates, which he said he can't actually do. Maybe they're not doing these asset purchases. But yeah.
Right. What tightening monetary policy does is it sends the signal that the economy is overheating. We need to tighten because the economy is doing so damn great. Look at inflation is going up and not coming down, right? That is the signal that they're sending to the market. When that's not true. The reason why they're sending that signal is because they want to make a self-fulfilling prophecy. They want to blunt any sort of deflationary downturn, which we'll get into here in the next story with the IMF. I mean, the economy around the world is doing very poorly, and it looks like a lot of places are going to have major financial collapses. And, you know, the Fed wants to build a narrative, a positive narrative to maybe help the economy, you know, for a soft landing instead of a hard landing. Does that make sense?
So in your mind, inflation is, or in the Fed's mind, inflation as a self-fulfilling prophecy is the lesser of two evils versus just grinding down to like a debt deflationary spiral.
Yeah, I mean, I don't think that their narrative can stop or can make inflation actually go up. Even if they're the best storytellers out there, they can't actually succeed in keeping inflation high. But they can blunt the downward effects on the economy. So as the economy slips back into recession, perhaps it's less steep, and shorter if they can blunt those, make people think there's actually inflation now to, go out and spend and go out and invest and all those things.
All right. Again, something that we've been covering for a long time here, and we'll continue to follow the narrative, see if Ansel is onto something. Again, a lot of unpopular opinions get dropped on this show, and I think that's why there's an edge here.
It's definitely a contrarian position. But yeah, this is the, I would say, Eurodollar position. For those that haven't been watching the Eurodollar position, Jeff Schneider and others, it's where the Fed, their main policy tool is jawboning. Okay, should we move on to the next thing?
Let's do it. IMF.
Okay, IMF. So can I share my screen on this stream? I don't know.
Ooh,
probably not.
Producer, no sharing screen this time. Let's just run through it. Yeah.
Well, I'll put the link down in the show notes for everybody. This was a blog post on the IMF website, December 2nd, by the president, Kristalina Georgieva, I believe you pronounced her name. And so I'll just start reading and then we'll talk about the first couple sentences. Despite significant relief measures brought on by the COVID-19 crisis, about 60% of low-income countries are at high risk or already in debt distress. In 2015, that number was below 30%. For many of these countries, the challenges are mounting. New variants are causing further disruptions to economic activity. And I'll have to stop here. It's not the new variants that are causing the disruptions, it's the response to the variants. But okay, COVID-related initiatives such as the G20 Debt Service Suspension Initiative, DSSI, are ending. And I think they're ending at the end of this year. Many countries face arrears or a reduction in priority expenditures. We may see economic collapse. In some countries unless G20 creditors agree to accelerate debt restructurings and suspend debt service while the restructurings are being negotiated. It is also critical that private sector creditors implement debt relief on comparable terms. So that's what I have from this blog post. I think it shows that there is deep concern by the IMF and others out there that there is massive financial stresses building, a dollar shortage building. And that's one reason why we've seen a surge in the dollar just recently. So Christian, what do you have thoughts on this?
Yeah, I mean, I think it's always interesting to see the contrast between the US and what Europe is saying, but it's pretty clear. And, we spoke about this at length in the last episode, which also aired on Bitcoin Magazine Live, but Europe is in trouble, and like there are severe issues. Again, I think that policymakers will always blame COVID because their assumption is that COVID happened and our response was inevitable, and therefore, the secondary effects of our response was because of COVID. But their response is absolutely not inevitable, and it's absolutely a choice. So therefore, the response should be kind of held, they should be responsible for their choices and for the second order effects that come out of that. But it's interesting that she says that one, the IMF and other creditors should try to help here, as almost like we're at war, we need your help, like forgive our debts. But on the flip side, that she said that also private creditors should also try to help. And again, we're seeing that these central bankers have built a system that no longer works under kind of like market-based dynamics, and they have to break those dynamics in order to make it work, which is the problem to begin with.
Yeah, I mean, these countries already had their loans deferred for 18 months, 12 to 18 months, and they're still in financial trouble and can't meet their payments. I mean, this to me, this speaks as some very, very deep financial issues in these low income countries and emerging markets. And this fits into kind of a thesis we've talked about here on the show where, you know, emerging markets and China and all that have been built off of easy credit over the last 50 years. And now when we're in this credit saturated world of low growth, the biggest and hardest hit are going to be those emerging markets. So this to me is confirming that, or at least giving one more piece of evidence to confirm that analysis.
So do you subscribe at all to like this idea of like a great reset where it's like, hey, we're in this area with all of these unsustainable processes and it's time to have a great jubilee and reorient around CBDCs or whatever else the powers that be, the Davos crew can kind of scrap together? Is that kind of part of your thesis and your mentality when you're looking at the global macro?
You mean like a cabal that's pulling the strings and central planning and stuff?
Sure. Like, let's just say we know that there are powerful figures that meet together, right? So let's just assume that they all agree that the system has gone past any sort of redemptionary phase. We got to start over, and we don't want to get reorganized in that move. You know, let's say that that's where we're at. You know, is that it? I guess, does it make sense to even think of, you know, the economy, you know, trying to be directed in sort of a centrally planned method towards like a new system that is going to forgive sins and keep things going?
Yeah, I think there are central planners out there that are going to try to do something like that, but they're fighting nature. You know, I kind of see that this whole era of globalization over the last 50 years was driven off of credit. That was their tool. And now the credit doesn't work anymore. So what's going to happen? Well, it starts falling apart. And especially the US, if they withdraw, you know, from the world and come home and they're no longer the peacekeepers or policemen of the world, we're going to see a lot of regional conflicts building up, like we obviously see in Ukraine right now, and we see on the border of Iran and Afghanistan already. There has been a military skirmish, and it's only been like 2 or 3 months. So I think that this era is coming to an end, and it's natural. The powers that be, the Davos crowd, like we talked about last week with Tom Luongo, they will try, but central planning never works. They can't do it. The great reset is Bitcoin, in my opinion, because their system is already tried. It's already built up this huge credit bubble, and Bitcoin is the answer.
All right, let's jump over to China from one sinking ship Europe to the next.
Okay, so the news out of China is that they lowered their reserve requirements, their reserve requirement ratio. That is the amount of assets to liabilities that a bank has to have. So if they can lower this amount of assets that they have to have per loan, they can make more loans, right? So I was just going to read a little bit of this headline out of the South China Morning Post. China's central bank says it will cut the reserve requirement ratio for major commercial banks by 0.5 percentage points, releasing 1.2 trillion yuan worth of long-term liquidity into the interbank system on December 15th. This is the second time that they've done it this year, and the first time was smaller. They said it was only 1 trillion yuan, but what happened to that? Like, why? Again, it's not quantitative because they keep having to do it over and over again. I think this also shows that there is major credit problems going on in China, a huge credit bubble collapse, and that will dovetail into the next story on Evergrande. Do you have any comments on the PBoC cutting reserve requirement ratio?
I mean, I feel like my commentary is always the same. It's like central planning bad. And you can kind of just see, I think you said it a lot more eloquently, that it's not quantitative. Nothing they do is quantitative. They're just reacting. and they're trying to manage this insane juggle of a international economy, and they're running out of tools and making something, like let's say they have these reserve requirements in order to create some sort of security within the system, like lowering those in a time of trouble is not like prudent activity. Like you're not fixing anything. So it's just a band-aid. Like you can't say that it's anything more than that. You're making something theoretically more risky that you already put in place, as a security, or for security, and you're calling that a win because it's going to relieve the economy with liquidity. It's like, why did you central plan how much reserves there have to be in the first place, and then why is this going to actually fix the problem? So I feel like I'm beating a dead horse here, but another example in the book of like, okay, here's this central planning process and it's not going to end well. Like you're saying, this is just another red flag of this economy is deeply troubled and they don't have any tools to fix it.
Absolutely. And this next part is just, I think, is a great contrast between Powell and the PBoC. So the PBoC said that the overall RRR cut was to fortify a cross-cycle adjustment of macroeconomic policies. That's just a bunch of gobbledygook in there, word salad. A catchphrase that represents a long-term view to inject liquidity support into the economy in advance to cope with potential challenges ahead. So see, they're signaling challenges ahead. Now, if I were an investor and the PBoC is saying red light, red light, red light, warning, challenges ahead, right? That's not as good as what Powell, he seems to be more polished central banker. And he says, look, we're doing so well. We just have to taper. We have to taper. Maybe we'll start raising rates. I mean, this stuff is transitory. Like I think it's night and day. With the Fed is very positive in that way, and the PBoC is not doing a good job.
All right. Well, speaking of not doing a good job, in China, they have been developing their countryside in a very centrally planned way once again. And they have these massive, state-backed, state-aligned, REITs and investment companies that are kind of part of this effort, central planning effort. One of them is Evergrande, and Evergrande has been making huge headlines for a very long time because of their default issues and their debt issues. Ansel, let's talk about why Evergrande is in the news again and what's the update there.
Well, Evergrande has been in the news recently because they couldn't meet their debt burden, right? They couldn't pay their coupons on all of their dollar-denominated debts. And they kept having 30-day grace period after 30-day grace period. No kidding. It's been like 3 months that they've pushed this back with another grace period. And now just this week, it might be, let's see. Yeah, I think it was at the end of last month is when they missed the coupon payment. So I'll just read this out here. Some offshore bondholders of China's Evergrande group did not receive coupon payments by the end of the 30-day grace period. 5 people with knowledge of the matter said, pushing the cash-strapped property developer closer to formal default. Hold on, I got my dog barking here. So yeah, so finally, they're not pushing this back with another grace period. They're actually going to default. Keep continuing. Failure by Evergrande to make 82.5 million in interest payments due last month would trigger cross default on its roughly 19 billion in international bonds and put the developer at risk of becoming China's biggest defaulter, a possibility looming over the world's second largest economy for months. There's also a the second largest offshore dollar debtor in China is this Cassia Group Holdings, and I'll read, they're starting to have some problems. So adding to a liquidity crisis in China's once budding property market, smaller peer Kaisa Group Holdings was also unlikely to meet its $400 million offshore debt deadline on Tuesday, a source with direct knowledge of the matter said. Non-payment by Kaisa would push the 6.5% bond of CAISA, China's largest holder of offshore debt among developers after Evergrande, into technical default, triggering cross defaults on its offshore bonds totaling nearly $12 billion. So just one after another, we're seeing this stuff happen in China, and this comes on the heels of the reserve requirement cut. So just China is just in bad shape.
So Europe bad, China bad, US faking like it's not bad. But again, the US is in a completely different position as the rest of these countries, at least from a monetary perspective. Maybe not from a resources or a production or anything else. Like, I don't know exactly how to suss up exactly how the US stacks up in terms of its ability to maneuver in a potentially antagonistic global environment. But well, right now, I would say that from a banking, a global central banking perspective, like the US is the power broker and still in control from a politics perspective, maybe not an economic perspective.
Yeah, well, I look at this geopolitically, right? So the US doesn't have any crazy borders. You know, we don't have any disputes over contested waters, or we don't have to worry about friends or countries on our border that we had our army, you know, under the Soviet Union. They were under the Soviets in Europe, in Eastern Europe, so they are always worried about Russia. China, South China Sea, and Taiwan, they have these disputes out there where the US doesn't. So in a world where we're all kind of facing these bad financial crises at the same time, the geopolitical crisis of a war on your border is going to tip the scale against you. And that's why I think the US is in prime position, and why maybe these Bitcoin miners, you know, they are coming to North America because they see this. There's less geopolitical risk in the United States. Investors will see that, and Bitcoin miners see that. So that's why I'm most bullish on the US. Plus, the US demographics aren't great, but they're better, much better than Europe, and much better than China. So that's why I think the winner here is the US.
So I guess before we close this one out, let's talk Bitcoin price a little bit. Over the weekend, obviously, price nuked. People obviously very disappointed. A lot of Bitcoin faithful expecting moon in December, similar to previous bull runs. I guess, what's your take on what's happening with Bitcoin price? You know, I definitely have my opinion. So, you know, let's riff on that.
Well, I'd like to hear your opinion first. I didn't think it was going to go below 50, but it did in dramatic fashion.
Yeah, I mean, my base case is that Bitcoin takes the way of most pain. So I think that that's definitely true. You know, Ansel, you know, I did that special with Bitcoin Tina almost 10 months ago, you know, kind of calling for Bitcoin to behave differently than previous cycles, just because the fact that, you know, in the past, Bitcoin was like a plaything, and today Bitcoin is a macro political asset that is maturing drastically, and the players within this ecosystem behave very differently than you know, early Bitcoin and crypto investors. So I just think it's a completely different ball game, and it's unwise to just assume that the halving dynamics, you know, are law more than everything else. So that was always kind of something that I was thinking of. But, you know, Bitcoin likes to play with your head, and, you know, there was definitely periods of time where I was like, yep, it's going to be exactly the same as previous bull runs, and, you know, we're going to have a blow off top, and there's so much froth here. And here's times where, you know, that's put to doubt. So I can't say that, you know, I'm a savant here, or I know exactly what's going to go down, but I do know that Bitcoin is going to take the way of most pain. So, you know, I can definitely expect more pain either to the upside or the downside moving forward. I think either at play.
Yeah, the market definitely has matured. It has different participants, and yeah, there is a lot of high-powered money now that can throw their weight around. And as you know, one of the things that people have been talking about recently is the amount of Bitcoins on exchanges has gone down dramatically. But to me, that also makes it a little bit more illiquid, right? So if the books are going to be a little bit tighter, and a big fat finger even, or a big dump, market dump, can send the price reeling. So yeah, it's much different. Now, my kind of understanding is that the gains are going to be shortened. So most of the gains are going to be within a much shorter window, instead of like 2017, where it just went up in a nice smooth parabola and you could have got in at almost any time in a whole year and reaped the gains. This time, I think it's, all the gains are going to come in a 2-month period, right? And then we're going to have a long period of up and down and false breakouts and big dumps, and then maybe 2 months of really rapid price appreciation. So that's kind of what I'm seeing.
I mean, that's kind of what Uptober felt like, right? So it was down all summer. September was painful. Like there was a lot of meme relief with, October going up, and then November, December so far, it's sideways and down. So
and then the whales then caught everybody on the all-time high breakout. So October, all-time high breakout, everyone's getting in, and then it comes back down. So it's the path of most pain. And
but if you just go back to Bitcoin Tina on Bitcoin part 5, we did lay out 3 scenarios. The previous historical consensus was, parabolic up and then, blow off top and crash. And then we laid out, a scenario where, it kind of just it's sideways and grinds up, every few months, and it's one of the best performing assets, but it's definitely not nearly as sporadic. And then the last kind of scenario is just straight sideways accumulation, months on months on months, and then a big pop and repricing, and then back to accumulation. And that's what we consider to be the hardest trade, just because it's so frustrating to be in that market. You're just sideways, and then it gets repriced, and then there's no opportunity after that. So you were in, you saw it. If you're out, if you weren't, you missed it. And if at any point you try to take profit, it's probably painful. So I just think Bitcoin's going to continue to take the way of most pain. So probably going to just be a very short repricing period and a lot of sideways like that. That's what makes the most sense to me.
Yeah, and taking this back to the macro and to geopolitics and stuff, if there's a new European debt crisis, once that starts becoming more realized by people, that's when the repricing event is coming. That's what I think is the next big spur for Bitcoin, is this emerging European debt crisis. So we'll see.
So I guess for the new people who may be tuning in live, why don't you explain the connection between Europe breaking down and Bitcoin? Because that's something we've talked about several times, and I think could be a good way to wrap this episode up.
Yeah, so Europe is facing a ton of headwinds. They have slowing industrial output. They have a energy crisis with record high natural gas rates coming from their perennial enemy, Russia, who has them kind of by the balls. And now Russia is on the doorstep of Ukraine, and those tensions could flare at any moment either way. So there is a lot of headwinds going on in Europe. Now, if they have kind of a European debt crisis 2.0, which I think could happen next year, or at least get kicked off next year, then that capital is going to look for a way to flee Europe, and it will go into dollar-denominated assets. It will go into the dollar and also Bitcoin. One reason why it will go into Bitcoin, I think, is because a strong dollar is bad for the economy, right? Because it increases everyone's debt burden, and we are at peak debt and all this stuff. So the smart money will see they don't want to dump all their euros for dollars necessarily, because they're going to hurt the global economy. So maybe they will go into Bitcoin, or at least maybe 20% into Bitcoin or 50% into Bitcoin, and that will be billions upon billions of dollars coming into Bitcoin in a very short period of time. We're talking a month or two, when people really realize that this European debt crisis is on the doorstep.
Well, we'll have to see how it plays out, y'all. But no matter what, Bitcoin is a macro asset, and things are pretty wild on the macro, from a macro perspective. So as things unfold across the globe, it's going to matter for Bitcoin. And in a lot of situations, unfortunately for the world, I guess fortunately for the world, unfortunately for Bitcoin, Bitcoin is kind of like the release valve for a lot of the pressure that has kind of been built up over the course of 50 years of fiat. Ansel, this was a great rip, a fun one, doing it live on Bitcoin Magazine Live. For all of the FedWatch listeners tuning in on the podcast, make sure to go subscribe to Bitcoin Magazine on YouTube. Tune into our live airings. We're going to be airing these live every single Tuesday on Bitcoin Magazine Live, and then releasing them as a show, as all of you are used to. And Ansel, thanks again for preparing such a fantastic breakdown of what is going on in global macro. Ansel, where can people find out more about you, learn more about your work, and learn more?
Bitcoinandmarkets.com is my website, or you can find me on Twitter at Ansel Lindner. Yeah, it was a great rip. This is what we do, guys, for FedWatch. So if you like talking macro and getting some contrarian opinions, I'm not right. I don't think I'm 100% right or anything, but there needs to be dissenting voices out there, and we're Bitcoiners, so we're used to being contrarians anyway, and this show fits right in there.
Awesome. Well, y'all follow me at CK_snarks, follow Bitcoin Magazine, sub to Bitcoin Magazine on YouTube. You know the drill. Peace.